Hey guys, it's Carter. Welcome back to the channel. I hope you guys are all having a great and amazing day today. In today's video, we are looking at a company that has been called the next Tesla, the Tesla of China. The company is NIO. We're going to be breaking down should you buy NIO in 2023. So I hope you guys enjoy it. If you have any questions, let me know down in the comments. And if you want to learn more about investing, money management, trading, make sure you guys subscribe to stay up to date on all of our videos. And we do have memberships where if you guys want to support the channel more, you guys can have loyalty badges, exclusive live streams and videos and all that good stuff. Make sure you guys at least check that out. So guys, let's jump into it. Come on. Now, before we answer that question of should you buy NIO, first we have to understand what is NIO. Well, NIO is an electric car company based out of China, and what we've seen is the company absolutely explode over the past couple of years. With that being said, the year-to-date deliveries are up 30%, which is pretty decent, right near and around 14,000 vehicles this year, which is decent. If you're comparing it to Tesla, Tesla is obviously the leader of the electric auto space, so it's not nearly as close when it comes to deliveries. Now, what NIO has found very, very successful is more of a subscription-based model in Europe compared to Tesla, which is almost just buy one time, don't have to worry about it. With NIO is you have money coming in every month, which is another great way the company makes some money. Now, the revenue is right near around 1.8 billion, which is so much money. On top of that, it's up about 20%. So you'd assume that with the revenue being up, the deliveries being up, that the general stock price would be up. No. The year-to-date return on NIO is down 63%. So you could have two mindsets when it comes to something like this. The first mindset is, okay, this stock is down 63%. I'm going to buy in at a more affordable price, buy and hold. It's already down 63%. And when the thing hits highs again, I'm up more money. Or you could say, oh my gosh, this thing's down 63%. I am staying away from it. It's a sinking ship. So I'll give you my opinion here in a second on which one I think is a better option. Now, one of the most important things when evaluating a company is something called the cash on hand. The reason why this is so important is because if NIO ever goes through a hard time or a struggle, what they can do is start pulling from that cash and continue to pay their employees, continue to invest in the business and grow it. If they ever go through a struggle, it's super important. And let me tell you, they do have quite a bit of cash. They have about $6.7 billion. Now, comparing that to the long-term debt, because if you have a lot of cash, but you have way more debt, that's a recipe for disaster. Now, NIO does have quite a bit of debt, but it's not nearly as much as the cash on hand. Now, NIO does have about $1.7 billion in debt, which isn't too bad, especially comparing it to that over $6 billion in cash, so they could easily pay off that debt if they ever needed to. But most of the time with these massive companies, they take on debt because virtually it's like free money for them because the interest rates were so low, or they have so much money that banks give them, these rates that are like unbelievably low, and the banks still make money. The car company or NIO doesn't have to pay it off. It's like a win-win for everybody. But now, I think probably the most important thing for evaluating a company is something called the net profit margin. Pretty much what this means is it's how much money NIO takes home. It's how much money they keep in cash and can store and grow and all that stuff. So NIO's net profit margin is negative 24%. Now, what this means is for every $100 NIO actually brings in, they lose $24 for every 100 they bring in. This is a recipe for disaster, because how can you grow a business if your net profit margin is negative? Comparing this to Tesla, Tesla's profit margin is right near anywhere from 15 to 20%. So meaning for every $100 Tesla brings in, they profit anywhere from $15 to $20. NIO, on the other hand, is the complete opposite. For every $100 they bring in, they lose another $24, which is terrible. You cannot grow and sustain a business if that's how your profit margin is. And now looking at the past couple of earnings, we've seen mixed earnings. So some earnings, they'll have fantastic revenue, but they'll have missed earnings per share, or it'll be the complete opposite where they have good earnings per share, but then missed revenue. So it's mixed, and anytime you have a mixed earnings, it's another recipe for disaster because investors don't know where to judge the stock. Is it growing or is it losing money? Is it growing or is it losing money? So it's very, very hard to judge. But now, answering that main question, right, that everybody has, should you buy NIO? This is my mindset with it. NIO for me is a stock that does carry potential. Obviously, we've seen the numbers, we've seen all the fundamentals that say, okay, the company brings in a lot of money. The revenue's up 20%, deliveries are up 30%. We've seen a lot of growth, but what we see is supply chain issues. We also see a whole bunch of things inside the company that isn't the greatest, like the net profit margin. So for me, it almost falls in like a higher risk, higher reward category. I would not go super heavy into this stock. The reason why is because you could lose a lot of money. The volatility on it is very, very high. Just how quick we've seen this thing sell off 63%, it could easily sell off another 30% or 40%. The downside is unknown. I think it does carry some potential. So my strategy would be to keep it under anywhere from 1 to 2% of your portfolio size. So meaning for every $100 you have invested into other stocks, assets, bonds, I would put $1 or $2 into this. Now the reason why it's so low is because if this thing sinks down and falls to zero, you're only out 1 to 2% of your portfolio. Now, if this thing starts squeezing up, what can you do? You always can buy more shares, and you'll have some shares to make you some money, and it's just a great way to invest into these higher growth, higher volatile growth stocks. That's my mindset with it, and that's what I've been doing. And obviously this year I'm down quite a bit, not to mention dollar cost averaging. What you're doing is every time the stock sells off, you're averaging down that price, so once the stock recovers, you make a lot more money. So guys, that is my mindset with it. I hope you guys all enjoyed the video. If you have any questions, let me know down in the comments, and we'll see you guys later. Remember to stay happy, stay positive, and stay safe out there. Take care.